What if I told you that one of the biggest financial disasters in British history didn't start with greed, but with desperation? That the scandal that nearly bankrupted an empire wasn't caused by a mastermind criminal, but by Parliament itself? What if the story of the South Sea bubbler scheme that collapsed so dramatically it ruined thousands, toppled leaders, and reshaped global finance was actually engineered to fail from the very beginning? Here's the mystery most people never learn in school. How did a company with no real business, no real profits, and no real assets convince the British public that it was the key to unimaginable wealth? And how did the world's most powerful nation fall for a scam so transparent that modern economists can agree on whether it was incompetence or deliberate political manipulation? The deeper you look, the stranger the story becomes. A national debt spiraling out of control, a company promising riches from the wrong ocean, a king bribed to support the scheme, and a stock price that multiplied ninefold in less than a year without a single piece of good news to justify it. Today, we're pulling back the curtain on this 300-year-old disaster, not as a dusty historical footnote, but as a warning, because almost every element of the South Sea bubble can be found in modern financial crises, from crypto crashes to housing bubbles to tech stock manias. And once you see the pattern, you can't unsee it. Before we get to the fraud, we need to understand the pressure cooker that created it. Britain, in the early 1700s, was in serious trouble. Decades of nearly continuous warfare had left the crown with a massive problem. The national debt had exploded to over £50 million, an astronomical number for the time. To put that in perspective, the annual government revenue was barely £5 to £6 million. Interest payments alone consumed most of that. The government needed a miracle, or at least, something that looked like one. Enter the South Sea Company. Formed in 1711, it wasn't created to trade goods or launch ships. It was created for one purpose: to take over Britain's national debt and somehow make money doing it. Its founders pitched Parliament on a clever idea. What if the government handed the company a monopoly on trade with Spanish South America, a region full of silver mines and lucrative ports? In exchange, the company would absorb massive amounts of government debt and convert it into shares. And thanks to this supposed monopoly, those shares would inevitably rise in value. There was just one tiny problem. Britain had no access to this South Sea trade. Spain controlled the region and refused to let Britain in. This meant the company's future profits were entirely imaginary. The entire premise was built on hope and political showmanship, but a desperate government doesn't look too closely at its lifelines. The scheme wasn't designed to trade goods or make a profit from the South Sea. It was designed to make share prices go up. And that's exactly what happened. The South Sea Company's business model was dangerously simple. Take government debt from the public, replace it with company shares, manipulate the share price upward, and profit from the rising prices, regardless of actual performance. The government supported this because it allowed them to refinance debt without raising taxes, a politically impossible option. But there was still no real trade happening. The company did secure one small permission from Spain to import slaves into its colonies, but even that generated far less profit than promised. Still, people believed, and the company learned something important. If you hype the idea of future riches loudly enough, no one cares about current profits. Sound familiar? By 1720, the South Sea Company made a bold move. It proposed taking over nearly all remaining government debt. In return, Parliament would guarantee interest payments and grant new privileges. But here's the shady part. The company would use its own rising stock price to finance the deal. The higher the share price went, the more debt it could absorb. The more debt it absorbed, the more legitimate the company looked. It was a self-reinforcing cycle. To push the price up, the company unleashed one of the earliest mass marketing campaigns in history. They bribed politicians, paid off journalists, and distributed pamphlets promising huge future profits. They even offered easy credit to investors by now. Pay later, and spread rumors about secret treaties and untapped riches. Newspapers praised the company daily. Coffeehouses buzzed with speculation. Aristocrats, merchants, even servants scrambled to get in on the action. In January 1720, South Sea shares traded around £120. By April, they hit £350. By June, £890. At its peak, the price was nearly £1,000, a ninefold increase in less than a year. And still, the company had no new earnings, no new trade deals, and no real profits. But people didn't care. Why? Because everyone was getting rich. The madness spread. Soon, dozens of copycat companies emerged, each more absurd than the last. Famously, one promoter launched a company described only as a company for carrying out an undertaking of great advantage, but nobody to know what it is. People threw money at it anyway. We laugh at that today, but millions did the exact same thing during the dot-com era, crypto mania, and with meme stocks. Human nature hasn't changed. The fatal flaw in the South Sea Company's design was always the same. The share price had to keep rising forever. But here's the rule of all bubbles. They grow slowly and burst quickly. By late summer 1720, early investors began cashing out. They saw the writing on the wall. The company tried desperately to prop up the share price, even offering to lend money to investors to keep buying. But the panic had started. As more investors tried to sell, buyers disappeared. Shares dropped from £1,000 to 700, then 400, then 150. Fortunes evaporated overnight. The same parliament that had cheered the scheme months earlier now panicked. By the end of 1720, the company's stock had lost nearly 90% of its value. When the bubble collapsed, anger swept the nation. People wanted accountability. A parliamentary inquiry uncovered massive bribery, forged documents, secret stock giveaways to politicians, and insider trading on a national scale. Major political figures were disgraced. Some fled the country, some were imprisoned. The human cost was staggering. Tens of thousands of investors lost everything. Generational wealth vanished in weeks. And the irony, the South Sea Company survived, but was reduced to a hollow shell. The most uncomfortable truth about the South Sea bubble is this: it keeps happening. Let's draw the parallels. A debt crisis leads to a desperate solution and an overhyped asset. In 1720, pamphlets trumpeted imaginary riches. In 2021, influencers hyped coins with no utility. The fear of missing out is the real engine of bubbles. And when governments and companies mix too closely, risk explodes. In 1720, parliament members accepted bribes. In modern times, lobbyists shape deregulation and politicians praise booming markets they barely understand. Let's finish with 3 key takeaways. First, a rising market doesn't mean a healthy market. The South Sea Company soared, but it was hollow. Second, when political credibility becomes financial marketing, the results are disastrous. When politicians start promising investment returns, be afraid. And third, human psychology, not math, drives bubbles. Greed, fear, and herd behavior shaped 1720 and every crisis since. The South Sea bubble didn't just wreck the British economy. It revealed that the greatest financial risks come not from markets, but from people in power. If the same patterns are reappearing today then the next great bubble may already be forming. The only question is, will we recognize it in time? If you want more deep dives into the financial scandals and historical disasters that shaped our world, make sure you subscribe, hit the notification bell, and leave a comment with the next economic mystery you want unwrapped. Because history doesn't just repeat itself, it compounds. And the more you understand it, the better prepared you'll be for what's coming next.